Welcome to the deep dive. Today, we're taking a scalpel to one of the most powerful, yet, let's face it, conceptually confusing technologies of the 21st century, blockchain.
Mm.
And if your mind immediately goes to volatile tokens, crypto bros and all that digital speculation, we really need you to clear the slate.
Yeah, that's right.
We are here to talk about infrastructure.
Exactly. We're moving way past Bitcoin, which is really just one consumer application of this technology. We are looking at blockchain as a truly foundational technology, a distributed ledger technology, or DLT, that is, it's transforming how value, information, and trust are managed globally.
So our mission today is to understand the engineering behind this idea of distributed trust, and more importantly, to really dissect a critical philosophical tension.
Okay.
This technology was born from the desire to remove centralized authorities entirely, yet its biggest global adopters, we're talking central banks, massive logistics firms, they're using it to reinforce control.
And that tension, right, the struggle between pure decentralization and, well, necessary governance, that's really the lens through which we have to view all these applications.
Hey, where do we start?
We have to start with the mechanism. A blockchain's core function is just maintaining a shared, tamper-resistant record of transactions among a bunch of different participants, and this is the key, doing so without a single central mediator.
Right. And as a quick historical anchor, this whole idea really crystallized with the 2008 Bitcoin white paper, which came out of the US. It basically pioneered a way for network participants to collectively validate and record information, totally bypassing traditional financial gatekeepers.
It was, in effect, a blueprint for trust based on mathematics, not institutions.
Which is exactly why that tension you mentioned is so fascinating.
It is. The promise was total trustlessness. But the reality is that the institutions adopting it, they absolutely require high levels of control.
Okay, let's unpack this, because if you are sitting there thinking, how can a record be shared among, I don't know, thousands of computers, yet stay totally trustworthy and unchangeable? That is the central puzzle.
It is.
What's the best metaphor to get our heads around the mechanics?
The metaphor of the chain is actually perfect. Just imagine a continuously growing digital chain. Each link or block holds a batch of verified transactions.
Okay.
The real engineering genius is in the fact that once a block is mathematically linked to the previous one, it is almost impossible to alter it retroactively. And that's what creates the so-called immutable ledger.
Okay, so we've got shared data, that's the distributed ledger part, but how do we make sure that data, once it's out there, is secure and can't just be quietly edited by some bad actor on the network?
That security is built on three pillars. The first one we've already mentioned, the distributed ledger.
Right.
All the network nodes, basically computers, hold a full identical copy of the entire record. So if one copy fails and gets corrupted,
The other 9,999 are still fine.
exactly, it eliminates that single point of failure.
Pillar number 2, which, this sounds incredibly complex, is cryptography.
It is the security layer, and it's probably the most important piece of that immutability puzzle. Every new block is given a unique digital fingerprint. It's called a hash value, and it's based on the data inside it.
A unique fingerprint.
A unique fingerprint. And crucially, that block's hash value is then included in the next block, which links them together cryptographically.
So if I'm trying to visualize this, the hash value of block A is literally locked into the structure of block B.
Precisely. And if someone were to go back and tamper with even a single transaction inside block A,
Just one tiny thing.
that tiny change instantly alters block A's unique hash value. And since block B is already stamped with the original hash of A, the cryptographic link is just broken.
The chain breaks.
The entire chain that follows it becomes invalid. It's a cascading failure that the whole network detects immediately.
Okay, that makes the security tangible. It's not just abstractly complicated, it's actually verifiable. So that brings us to the third pillar, the consensus mechanism. Security is one thing, but getting thousands of different parties or, hundreds of competing banks to agree on which transaction is valid and which block is next in line, that sounds impossible.
The consensus mechanism is just the set of rules that governs that agreement. And what's really fascinating here is that the mechanism you choose defines the whole system. Different systems solve for different priorities.
And we can basically group these into 2 types, right?
That's right.
The ones that get all the headlines are the public blockchains.
Yes. Public blockchains, like Bitcoin, they prioritize maximum decentralization and trustlessness. They use mechanisms like proof of work, which requires just huge amounts of computational effort, or proof of stake, where participants have to stake their own value to secure the network.
And those are often slower, but super resistant to censorship.
They are. But the focus of institutional adoption, the one that ties back to our central tension of control, is the permissioned blockchain.
Right.
Absolutely. Institutions, banks, governments, big companies, they can't wait 10 minutes for a transaction to clear. And they have to follow KYC and AML regulations.
Know your customer, anti-money laundering.
Exactly. So they deploy permissioned blockchains. These use much faster, more controlled consensus models where all the participants are known and they're vetted. They're sacrificing that ideal of pure trustlessness for the pragmatism of regulatory compliance and strong governance.
That immediately puts the benefits into a business context. So now that we know how it works, let's talk about the payoff. How does this shared secure record translate into, tangible benefits for you, the listener, especially in high-stakes environments like finance?
Well, the benefits really revolutionize efficiency. First, you get transparency because all the authorized parties can see the ledger, which removes informational asymmetry. You also get phenomenal security because of the immutability we just talked about.
But the big one for institutions is efficiency.
The biggest gain, institutionally, is efficiency. When you remove all the reliance on manual reconciliation and layers of intermediaries, you go from days or hours of settlement time to near real-time verification.
And cutting those delays, that's huge for cutting capital costs. But beyond just speed and cost, DLT unlocks innovations that fundamentally change how we use money and contracts.
That's where the advanced capabilities come in. The two biggest are smart contracts and programmable money.
Okay, let's start with smart contracts. We hear the term all the time, but what's the real conceptual shift there?
A smart contract is basically an automated program. It's code that executes a specific action when some predefined conditions are met.
Like an if-then statement.
Think of it exactly like an if-then statement, but written on the blockchain. The conceptual shift is profound. You're moving power from legal enforcement, which relies on courts and lawyers and, potentially years of litigation,
to code enforcement.
the code enforcement, which is immediate and self-executing.
So if I buy a tokenized digital bond, the smart contract can automatically pay me the coupon interest on the exact date and transfer the funds without a single human having to sign off on it.
Exactly. It reduces counterparty risk, and it eliminates so much administrative overhead. And this leads right into programmable money. It provides the infrastructure foundation for things like decentralized finance or DeFi and asset tokenization.
So money itself becomes intelligent in a way?
It means money can be embedded with rules, constraints, destinations, all managed by code, rather than just being a static thing waiting for a human to tell it what to do.
Let's ground this in reality with a few quick examples. Where are these innovations actually being deployed today?
We're seeing rapid adoption in several key areas. In payments, cross-border transfers are bypassing those traditional, really expensive correspondent banking networks, cutting both cost and settlement times significantly.
And for capital markets?
For capital markets, the issuance of digital securities and real-time settlement are automating everything from trading to corporate actions.
What about verifying things in the physical world, like the provenance of goods?
Supply chains are a perfect fit. Blockchain provides these immutable product provenance records, so you can trace goods from the source all the way to the consumer. This is crucial for reducing fraud, authenticating high-value assets, and ensuring the safety of things like pharmaceuticals or food.
And finally, identity. That's often talked about as the next big frontier.
Decentralized identifiers, or D-Days, are emerging. So instead of relying on these centralized, siloed databases, think of your hospital or your bank, to store sensitive personal data.
You control your own data.
DIDs give individuals true control. You decide who sees what, when they see it, and for how long.
Okay, here's where it gets really compelling and where we revisit that central tension. The sources show that countries adopt blockchain not based on some unified ideology, but based on their specific economic needs and their governmental structures.
This is so critical because it shows the technology adapting to the environment, not the other way around.
So let's dissect the regional variations. Where do you want to start?
Let's start with the United Kingdom. It have a highly mature and very heavily regulated financial sector.
So the UK, they're clearly prioritizing stability and regulatory reporting over, full decentralization.
Precisely. Their focus is on industry pilots for things like interbank payments, settlement systems, and heavy experimentation in asset tokenization, turning real-world assets into digital shares.
And crucially, they're using permission networks.
Overwhelmingly. They need the efficiency gains, but they have to retain governance and auditability for regulators. They want to make sure the technology supports, rather than subverts, their existing rule structure.
That's a really stark contrast to, say, India's primary motivation.
It is. India seems focused on internal governance and transparency.
How so?
India is leveraging DLT to complement its massive digital public infrastructure. The use cases are all about providing tamper-proof audit trails for public service delivery, most famously in land record management and property registration in several states.
So this is about fighting corruption and proving authenticity to citizens.
Yes, not just optimizing bank transfers. Private firms there also use it for tracing agricultural produce, verifying complex trade finance documents, and for microlending.
Okay, now let's go to China. The strategy there feels purely national and strategic, and it's operating at an incredible scale.
China views blockchain as a key national technology. They're dedicating enormous resources to its development, but almost entirely within the confines of permission systems.
And what's their focus?
Logistics, trade, and supply chain management. Think massive cross-border shipping documentation networks. They prioritize efficiency and the ability to verify product authenticity across vast digital platform ecosystems that are all coordinated by the state.
Then you have Singapore, which is positioning itself as this nimble global financial hub.
Singapore's monetary authority has been leading initiatives focused on cross-border payments, foreign exchange settlement, and huge digital asset tokenization projects, like tokenizing government bonds.
For their multi-currency trade environment, that must be a huge advantage.
It's a massive competitive advantage. Blockchain's ability to reduce friction and reconciliation headaches between different currencies and jurisdictions is just perfect for them.
Let's shift to regions where adoption is being driven by, well, immediate, almost existential necessity, Africa and Latin America.
In the African continent, yeah, adoption is often driven by the high cost and unreliability of legacy systems. The number one use case is reducing the astronomically high cost of cross-border remittances by using faster, cheaper blockchain-based rails.
And beyond money transfers.
The technology is vital for identity verification, things like verifying university credentials or property rights, and for authenticating physical goods like minerals or pharmaceuticals, especially in areas where trust in central bodies might be, limited.
The power of decentralization really comes to the fore when those centralized systems are failing or are just prohibitively expensive. And what about in Latin America?
There, the drivers are financial inclusion and, critically, asset protection against macroeconomic instability. Countries battling high inflation are seeing significant use of stablecoins and local blockchain-based payment systems for just everyday commerce.
So it's about preserving value.
Preserving value outside of volatile local currencies. They need faster remittances, transparent government procurement, and there's huge interest in asset tokenization, real estate, commodities, things like that.
So we have this amazing tapestry of adoption where the same underlying tech is solving everything from national corruption in land records to protecting personal wealth from hyperinflation.
It really is.
Which brings us to the future trajectory. What are the major hurdles the technology has to overcome to truly become global core infrastructure?
The biggest hurdles right now really revolve around scalability. So the sheer volume of transactions systems can handle and interoperability.
Getting all these separate ledgers to actually talk to one another.
To talk to one another smoothly, yes.
So what are the technical innovations that are trying to solve these huge, complex problems?
We're seeing massive resources being poured into privacy-enhancing technologies, specifically the rise of zero-knowledge proofs.
Okay, that sounds like something from a sci-fi movie.
It kind of does, but it's a very powerful cryptographic tool that lets you validate a statement to prove that data is correct without actually having to reveal the underlying sensitive information.
Which seems critical for regulated industries. A bank needs to know its counterparty is vetted, but it doesn't want to expose its proprietary trade secrets to every single node on the ledger.
Precisely. It lets institutions maintain regulatory compliance while still getting the shared security of the DLT. And alongside this, we're just seeing integrations deepening everywhere.
Like with central bank digital currencies.
The expansion of central bank digital currencies, tokenized deposits, regulated digital asset markets, all of it signals blockchain's irreversible move into institutional finance.
So we started this deep dive by highlighting that tension between the tech's decentralized, trustless origin and the institutional need for control. As we look forward, are we basically just moving toward a compromise?
We are absolutely moving toward a compromise. Or maybe a synthesis. The future is defined by hybrid models. These are systems that successfully balance the revolutionary decentralization capabilities that DLT offers with the institutional need for high governance, compliance, and regulatory oversight.
So it's no longer about replacing the system.
It's about making the system exponentially more efficient.
This deep dive has shown that blockchain is rapidly evolving from, a niche idea into core infrastructure supporting global payments, complex contracts, verifiable identity, and international value exchange. It's the digital plumbing of tomorrow.
Indeed. And as we wrap up, it raises one final, I think, provocative question for you to consider.
Okay.
When you look back at the original impetus, that 2008 white paper, the goal was to build a system where trust in people and governments was irrelevant, and it was replaced entirely by math.
Right.
Yet the most successful, most scaled global implementations are precisely those where the technology is constrained and regulated by existing state and financial authorities.
So a system designed to remove our trust in institutions is being adopted primarily to improve the efficiency of those very same institutions.
That's the paradox, isn't it? How will this fundamental tension between the absolute ideal of trustlessness and the practical necessity of institutional control, how will that shape the ultimate definition of decentralization in the global economy over the next decade?
A battle being fought not with code, but with compliance manuals.
That's a great way to put it.